There is a phrase, a piece of financial scripture, so deeply ingrained in our collective consciousness that to question it feels like questioning gravity itself. You've heard it from your parents, from your first financial advisor, from every talking head on every business news channel. It is the foundational commandment of modern personal finance. Don't put all your eggs in one basket. This simple, folksy wisdom is the bedrock of diversification. The idea that spreading your money across dozens, if not hundreds, of different investments is the safest, smartest, and only responsible way to build wealth. It is presented as an unquestionable truth. And according to the man who built one of the world's greatest fortunes, a fortune currently valued at over $100 billion, it is profoundly and dangerously wrong. Warren Buffett, the chairman and CEO of Berkshire Hathaway, has a different, almost heretical take on this sacred cow of investing. In his characteristically blunt style, he has stated, "Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing." This statement is not just a contrarian opinion. It is a direct assault on the entire institutional framework of wealth management. It suggests that the core strategy being sold to millions of people is not a path to wealth, but a shield for a lack of knowledge. This video is an exploration of that explosive idea. We are going to deconstruct Buffett's logic piece by piece to understand why he believes that for the serious investor, the person truly committed to achieving financial freedom, portfolio concentration is not reckless. It is the most rational path to extraordinary returns. We will delve into the powerful psychology, the practical mental models, and the hard financial realities behind a philosophy that champions a few, well-understood, high-conviction bets over a sprawling, mediocre, and ultimately misunderstood collection of assets. This is not an invitation to gamble. It is a call to elevate your thinking, to do the work, and to gain the courage to act decisively when you have a rare and genuine insight. You are about to learn the difference between diversification and what Buffett and his partner Charlie Munger call di-worsification, the process by which investors dilute their best ideas with their worst ones, guaranteeing a future of average results. Prepare to have your most fundamental beliefs about money and risk challenged, because the journey to exceptional wealth begins with the willingness to abandon conventional wisdom. The cornerstone of Warren Buffett's entire investment philosophy, the central pillar upon which his argument against diversification rests, is his radical redefinition of risk. For the entire financial industry, for the academics who write the textbooks, and the advisors who manage our retirement accounts, risk has a very specific mathematical definition: volatility. It's the measure of how much an asset's price bounces up and down. A stock that swings wildly is risky. A portfolio spread across 200 stocks that moves in a smooth, gentle upward line is safe. But to Buffett, this is a dangerous intellectual error. He believes that true risk is not the temporary fluctuation of a stock quote on a screen. It is the permanent loss of capital. It is the chance that the money you invest will be gone forever. And the single greatest cause of permanent capital loss is not volatility, it is ignorance. It's investing in a business you do not fundamentally understand. From this perspective, the quote, "diversification is a protection against ignorance," transforms from a clever jab into a profound truth. It means that diversification is a strategy for people who admit, either openly or implicitly, that they do not know the true value or the long-term prospects of the individual things they are buying. They spread their bets precisely because they are aware that some of them will be bad ones. They are hoping that the winners will outweigh the losers. But for the investor who has done the painstaking work to deeply understand a business, this approach is absurd. Why would you take a significant portion of your capital from your single best idea, an idea you understand inside and out, and move it to your 20th best idea, an idea you barely understand at all, simply in the name of safety? This is the ignorance fallacy, the mistaken belief that owning more things makes you safer, when in fact it often just multiplies the number of ways you can be blindsided by your own lack of knowledge. To truly grasp this concept, we must travel back in time to the early 1960s, to a moment that would define Buffett's career and crystallize his thinking on risk and concentration. This is the story of the great salad oil scandal. and Buffett's enormous, career-defining bet on American Express. At the time, American Express was a beloved blue-chip stock. Its primary businesses were travelers' checks and credit cards, both built on the unimpeachable foundation of trust. But it had another, more obscure division, a warehousing subsidiary. This division would issue receipts to companies that stored commodities in its tanks, and those companies could then use these receipts as collateral to get loans from banks. One of its biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. In November of 1963, the financial world was rocked by a shocking revelation. Tino DeAngelis was a fraud on a massive scale. He had been filling his giant storage tanks mostly with water, with only a thin layer of valuable salad oil floating on top. The inspectors would measure the oil from the top, and the scam went undetected for years. When the truth came out, Allied Crude collapsed, defaulting on loans worth an estimated $175 million, a colossal sum at the time. The warehouse receipts, backed by American Express, were now worthless. Wall Street panicked. The logic was simple and brutal. American Express had guaranteed the receipts. The receipts were worthless. Therefore, American Express was on the hook for the entire $175 million. This figure was larger than the entire net worth of American Express at the time. The company, it seemed, was facing bankruptcy. The stock price was obliterated, plummeting by nearly 50% in a matter of weeks. The herd was selling. To the diversified investor, American Express was radioactive. A perfect example of a single stock blow-up that their strategy was designed to avoid. But Warren Buffett, running his small investment partnership in Omaha, saw not risk, but opportunity born from ignorance, the market's ignorance. While everyone else was focused on the headline number and the potential liability, Buffett did what he always does. He went out and did the homework. He didn't just read the financial statements, he engaged in what he called scuttlebutt. He went to banks, he went to merchants. He stood in line at restaurants and travel agencies, he observed customers, he was trying to answer a different question. Not, what is the potential legal liability, but has this scandal damaged the fundamental business, the core economic engine of the company? What he discovered was powerful. He saw that customers were still using their American Express travelers' checks. Merchants were still proudly accepting the American Express credit card. The fear and panic that had gripped Wall Street had not trickled down to the actual consumers who powered the business. The brand, the mode of trust in the minds of millions, was completely intact. Then, he dug into the legal situation. He realized that the market was assuming American Express would be held liable for all of DeAngelis's fraud. But Buffett, after reading the fine print and understanding the legal arguments, believed it was far more likely they would settle for a fraction of that amount, a painful but survivable loss. He had replaced the market's ignorance with his own deep, first-hand knowledge. So what did he do? Did he take a small, prudent position? No, he acted with incredible conviction. Buffett invested 40% of his entire partnership's assets into American Express stock. This was not a diversified bet. It was the epitome of portfolio concentration. It was a single, massive wager that his knowledge was superior to the market's fear. In the next few years, his thesis played out perfectly. The scandal faded, the legal liabilities were manageable, and the core business continued to thrive. The stock price roared back, making an immense fortune for Buffett and his partners. This story is the perfect illustration of the ignorance fallacy. The market, acting on incomplete information and fear, saw American Express as infinitely risky. The diversified investors sold. Buffett, armed with deep knowledge, saw it as deeply undervalued and minimally risky, defining risk as the chance of permanent loss. His concentrated bet wasn't a gamble. It was the logical and inevitable result of having done the work the rest of the market was too lazy or too scared to do. The reason this counterintuitive approach works so powerfully can be explained by a deep-seated psychological flaw in how our brains are wired, the Dunning-Kruger effect. This well-documented cognitive bias describes a phenomenon where people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. In the world of investing, this is a catastrophic trait. The modern financial ecosystem almost seems designed to amplify the Dunning-Kruger effect. With a few clicks, anyone can open a brokerage account and buy fractional shares of 200 different companies. This ease of access creates an illusion of knowledge. An investor might own shares in a semiconductor company, a biotech firm, a renewable energy utility, and a Latin American e-commerce giant. They feel sophisticated. They feel diversified. They feel safe. But what do they actually know? Can they explain the competitive landscape of the semiconductor industry? Can they read and understand a clinical trial report for the biotech firm? Can they analyze the regulatory environment for utilities in their specific region? In 99% of cases, the answer is a resounding no. They have mistaken familiarity, seeing the company's name in the news, for genuine understanding. Diversification allows this self-deception to persist. Because no single position is large enough to cause catastrophic failure, the investor is never forced to confront the true depth of their ignorance. They can get away with knowing just a little bit about a lot of things. Buffett's philosophy of portfolio concentration is a brutal and effective antidote to the Dunning-Kruger effect. It forces you to be intellectually honest. When you are considering investing 20, 30, or even 40% of your net worth into a single company, the stakes are suddenly terrifyingly real. You can no longer afford to fake it. The prospect of that level of commitment forces you to ask the hard questions, to push past the superficial headlines, and delve into the gritty details of financial statements, management conference calls, and industry reports. It compels you to move from a state of unconscious incompetence to one of conscious incompetence, the humble admission that you don't know enough. And only from that starting point can you begin the hard work of building true, conscious competence. This is why focus investing is, paradoxically, a risk reduction strategy for the diligent. It acts as a filter. It prevents you from making investments until your level of knowledge and conviction is extraordinarily high. It protects you from your own worst instinct, which is to believe you are an expert when you are, in fact, a novice. So how can we translate this powerful philosophy into a practical tool? The answer is to create a systematic process for rooting out ignorance in your own financial life. We can call this the ignorance audit, a mental model designed to stress test your understanding of what you own. This is a blueprint for action. First, you must list every single individual stock, bond, or fund you own. No exceptions. Second, for each holding, you must answer a series of 5 increasingly difficult questions, and you must write down the answers. Be honest. There is no one to impress but yourself. Question 1 is the pitch. Can you explain what this business does and how it makes money to an intelligent 10-year-old in 60 seconds? If you can't, you are starting from a place of profound ignorance. Selling should be your default position. Question 2 is the moat. What is this company's durable competitive advantage? Why will it be able to fend off competitors and earn high returns on capital for the next 10 to 20 years? Is it a powerful brand, a network effect, high switching costs, or a low-cost production process? If you cannot clearly articulate the moat, you don't understand the foundation of its long-term value. Question 3 is the competitors. Who are the 3 biggest and most dangerous competitors to this business, and what is your specific evidence-backed argument for why your company will win against them over the long run? Vague answers like "they have better management" are not acceptable. You need concrete reasons. Question 4 is the numbers. Without looking it up, what is the company's approximate revenue, its profit margin, and its level of debt? You don't need to be exact to the dollar, but you need to be in the right ballpark. If you don't have a basic grasp of the company's financial health, you are flying blind. The final and most important question is the valuation. What is your rational calculation of this company's intrinsic value, and how does the current stock price compare to that value? This requires you to have a methodology, whether it's a discounted cash flow analysis or a multiple-based approach. The key is to have a reasoned opinion on what it's worth, independent of its fluctuating stock price. This provides your margin of safety. After you complete this ignorance audit for your entire portfolio, the path forward becomes clear. The holdings for which you had crisp, confident, evidence-backed answers are your candidates for concentration. These are your true, high-conviction ideas. The holdings where you struggled, gave vague answers, or simply drew a blank are the manifestations of your ignorance. These are not sources of safety. They are sources of unknown risk. The logical step in the Buffett framework is not to add more of them, but to eliminate them, concentrating your capital into the few businesses you understand as well as you understand your own. The path taken by the vast majority of investors, the 99%, is the polar opposite of this rigorous knowledge-based approach. It is the path of the collector. The average investor's portfolio is not the result of a deliberate, concentrated strategy. It's an accidental accumulation of financial products. It's a museum of past tips, hot trends, and haphazard decisions. They buy a stock because a friend mentioned it at a barbecue. They buy another because a pundit on television sounded convincing. They add a thematic ETF for robotics or clean energy because it's a compelling story. They bought a cryptocurrency because they had a fear of missing out. Over time, their portfolio comes to resemble a cluttered garage filled with dozens of items, none of which they truly understand or have a use for anymore. This collector's mentality is driven by the desire to be in on the action, everywhere at once. The catastrophic consequences of this approach were laid bare during the dot-com bubble of the late 1990s. Millions of ordinary people, caught up in the new paradigm frenzy, became collectors of internet stocks. They didn't just buy one or two, they diversified. They bought a piece of Pets.com, a slice of Webvan, a share of eToys, and a dozen other companies with .com in their name. They felt smart and safe because their eggs were in many different, albeit similar, baskets. They had no deep knowledge of any of these businesses. They couldn't have explained the business models, the cash burn rates, or the lack of any competitive moat. They were operating on pure narrative and social proof. When the bubble burst in 2000, their diversification offered no protection. It simply meant they got to watch all 50 of their stocks plummet in unison. They didn't lose money on one bad bet. They lost money on 50 ignorant bets. This is the ultimate danger of the ignorance fallacy in practice. Diversification, when it is merely a substitute for thinking, becomes a mechanism for participating in mass delusion. It provides the psychological comfort to make foolish decisions on a grand scale, ensuring that when the tide of market sentiment goes out, you are left exposed, owning a little bit of everything that is going to zero. The financial impact of choosing knowledge-based concentration over ignorant diversification is not subtle. It is a chasm that widens into a vast fortune over time. On a balance sheet or in a portfolio statement, this difference manifests in a concept known as active share. Active share is a measure of how much a portfolio's holdings differ from its benchmark index, like the S&P 500. A portfolio with a high active share is making big, concentrated bets that are different from the market. A portfolio with a low active share looks almost identical to the index. A typical diversified mutual fund, owning 150 stocks, might have a low active share. They are, in essence, charging you high fees to just hug the index. Warren Buffett's portfolio at Berkshire Hathaway has an extraordinarily high active share. He is not trying to mimic the market, he is trying to trounce it. The financial drag of a low active share, di-worsified portfolio is immense. Imagine two investors, each with $100,000. Investor A, the diversifier, buys 50 stocks, putting $2,000 in each. Investor B, the concentrator, does deep research and buys only 5 stocks, putting $20,000 in each. Now, let's say each investor is brilliant enough to find one company that turns into a 10-bagger. It increases in value by 10 times. For investor A, their $2,000 position grows to $20,000. It's an $18,000 gain. On their $100,000 portfolio, that's an 18% lift. It's nice, but it's diluted by the other 49 holdings that likely just plodded along with the market. Their single greatest insight had only a modest impact. For investor B, the concentrator, their $20,000 position grows to $200,000. It's a $180,000 gain. This single decision more than doubled their entire portfolio. Their single greatest insight was allowed to have a monumental, life-changing impact. This is the brutal mathematics of focus investing. Your best ideas, if you are diligent enough to produce them, will be so much more powerful than your 50th best idea that it is a catastrophic financial error to give them equal, or even similar, weighting. By diversifying, you are mathematically guaranteeing that the performance of your best insights will be shackled to the mediocrity of your average ones. You are capping your own upside in the name of a false sense of security, a security that vanishes the moment you realize that true risk was never volatility, but the quiet, creeping, and catastrophic cost of your own ignorance. If the first pillar of Buffett's philosophy is about redefining risk, the second pillar provides the psychological discipline required to act on that new definition. It's a beautifully simple, yet profoundly powerful mental model known as the punch card mentality. Imagine, Buffett says, that when you are born, you are given a punch card with only 20 punches on it. Each time you make an investment decision for the rest of your life, you have to use one of those punches. Once all 20 punches are used, you can't make any more investments. You are stuck with what you have. Under those conditions, how would your investment behavior change? You would, of course, become extraordinarily careful. You would think for weeks, months, perhaps even years before using one of your precious punches. You would not swing at every pitch. You would wait for the perfect, fat pitch right down the middle of the plate. You would only invest in your absolute highest conviction ideas, the ones you understood so deeply that you were nearly certain of their success. You would, by necessity, end up with a highly concentrated portfolio of a few outstanding businesses that you plan to hold for a very, very long time. This, Buffett argues, is precisely how all investors should behave, even though they live in a world that allows them to make thousands of trades. The punch card is a device for imposing artificial scarcity on your decisions, and in doing so, it dramatically improves the quality of those decisions. It's a direct counterattack on the frantic, high-turnover activity that characterizes modern markets. It transforms investing from a hyperactive game of speculation into a deliberate, patient, and methodical process of capital allocation. This mentality naturally leads to a concentrated portfolio, because the bar for what constitutes a punch-worthy idea becomes incredibly high. A merely good idea isn't enough to warrant using one of your 20 lifetime slots. It has to be a truly great idea, purchased at a significant discount to its intrinsic value. The origin of this powerful idea can be traced to Buffett's longtime business partner, Charlie Munger, but its most vivid application can be seen in one of Buffett's greatest investments, the Washington Post. We travel now to the years 1973 and 1974. The United States was in a state of turmoil. The Vietnam War was ending, the Watergate scandal was consuming the nation, and the economy was mired in stagflation. The stock market was in the midst of a brutal bear market, with stocks of even the best companies being sold off indiscriminately. It was a time of deep pessimism. The Washington Post Company, despite its journalistic triumphs in breaking the Watergate story, was not immune. Its stock price had been hammered, falling by nearly half. The market saw a newspaper company facing rising costs and an uncertain economic future. But Warren Buffett, viewing the world through the lens of his punch card, saw something entirely different. He saw a rare opportunity to use one of his precious punches. He wasn't just looking at a newspaper, he was analyzing a media fortress with a deep, unbreachable moat. At the time, Washington, D.C. was essentially a one-newspaper town. The Washington Post had a complete stranglehold on the local advertising market. If a department store, a grocery store, or a car dealership wanted to reach the affluent and powerful population of the nation's capital, they had no choice but to advertise in the Post. This gave the company tremendous pricing power. Furthermore, the newspaper was an iconic brand, synonymous with journalistic integrity and national importance. It was a dominant franchise, the kind of business that could weather economic storms and continue to gush cash for decades to come. Buffett conducted his usual deep dive. He analyzed the financials, he understood the competitive dynamics, and he built a relationship with the company's management, Katharine Graham. He calculated that the entire company was being valued by the stock market at around $80 million. Buffett thought this was absurd. He knew that just one of the company's assets, its television stations, were probably worth more than that alone. You were essentially getting the world-famous newspaper, a national icon, for free. He had found his fat pitch. This was an idea worthy of a punch. Over the course of 1973, Berkshire Hathaway invested nearly $11 million to acquire a large stake in the company. It was a massive position for the size of Berkshire at the time, another example of extreme portfolio concentration. He wasn't buying a basket of media stocks. He was buying one that he believed was the absolute best. He was punching his card with conviction. The result was spectacular. The market eventually recovered from its pessimism and recognized the incredible economic power of the Washington Post. Over the next 3 decades, Buffett's $11 million investment would grow to be worth over $1 billion, a return of more than 100 times his initial capital. This investment wasn't a lucky bet. It was the direct outcome of the punch card mentality. The discipline of waiting, the patience to ignore the market's mood swings, and the courage to act decisively and in a concentrated fashion when a truly magnificent opportunity presented itself is the very essence of this powerful investment strategy. The psychological mechanism that makes the punch card mentality so effective is its ability to short-circuit 2 of our brain's most self-destructive tendencies, the paradox of choice and decision fatigue. The paradox of choice is a concept popularized by psychologist Barry Schwartz, which posits that while we think more choice is better, an overabundance of options can actually lead to paralysis and anxiety. When an investor faces a universe of over 10,000 publicly traded stocks, the sheer volume of options is overwhelming. This often leads to shallow analysis, a tendency to follow trends, or simply buying a little bit of everything to avoid the difficult task of making a truly meaningful choice. The punch card mental model brilliantly solves this problem. By artificially constraining your options to just 20 for a lifetime, it changes the entire frame of the problem. Your brain is no longer trying to sort through 10,000 possibilities. It is now on a quest to find the 20 best. The task shifts from one of overwhelming breadth to one of profound depth. It forces you to ignore the noise and focus only on the signal. The second psychological flaw it combats is decision fatigue. This is the well-researched idea that the quality of our decisions deteriorates after a long session of making them. A person who is constantly tinkering with their portfolio, buying a little here, selling a little there, is making dozens of low-quality decisions. Their brain is tired. They are more likely to make impulsive choices, react emotionally to market news, and deviate from their long-term strategy. The punch card mentality is the ultimate cure for decision fatigue, because it minimizes the number of decisions you have to make. You are not a day trader. You are a capital allocator. You are not looking for a quick profit. You are looking for a business to own for a decade or more. This dramatic reduction in decision frequency means that when you do decide to act, when you finally choose to punch your card, you can bring the full force of your mental energy and analytical capabilities to bear on that single choice. You are making fewer decisions, but they are of vastly higher quality. It prevents you from squandering your limited willpower on insignificant market noise and conserves it for the few moments that will truly define your financial future. It's a system for replacing frantic, low-quality activity with patient, high-quality, and ultimately far more profitable deliberation. To make the punch card mentality an actionable part of your investment process, you need a formal system that forces you to meet its high standards. This blueprint is called the Investment Thesis Mandate. It is a non-negotiable requirement that before you are allowed to punch your card on any investment, You must first create a written document, a minimum of 1,000 words, that lays out your entire case. This act of writing forces clarity of thought and exposes weaknesses in your reasoning in a way that just thinking about it never can. The document must contain 5 specific sections. Section 1 is the elevator pitch. This is a single, concise paragraph that explains what the business does, who its customers are, and how it makes money. If you cannot summarize the essence of the business simply, you don't understand it well enough. Section 2 is the moat deep dive. This is the longest and most critical section. Here, you must detail the company's competitive advantage. Is it a brand? Network effects? Switching costs? You must provide specific evidence for why this moat is not just present, but durable. How likely is it to be just as strong or stronger in 10 years? You need to argue against yourself and try to find holes in the moat's integrity. Section 3 is the key performance indicators. You must identify the 3 to 5 key metrics that truly drive the value of this business. For a social media company, it might be daily active users and average revenue per user. For a railroad, it might be operating ratio and revenue per ton-mile. This shows you understand the underlying economics and gives you a dashboard to monitor the health of your investment over time. Section 4 is the pre-mortem. This is an exercise in structured pessimism. You must imagine it is 5 years in the future and the investment has been a complete disaster. Now write the story of what happened. What went wrong? Was it a new competitor? A technological disruption? A management failure? By identifying the most likely paths to failure in advance, you can better assess the true risks of the investment and avoid those with obvious fatal flaws. Finally, Section 5 is the valuation case. In this section, you must lay out your explicit calculation of the company's intrinsic value. Show your work. What are your assumptions about future growth and profitability? What is your target purchase price that would provide a significant margin of safety? This prevents you from getting caught up in a great story and overpaying for a wonderful business. Only when this entire document is complete, when you have wrestled with the arguments and put them down in black and white, are you permitted to punch your card. This process ensures that every one of your 20 punches is the result of deep work, intellectual rigor, and profound conviction, not a fleeting impulse. The path of the 99% is a stark contrast to the deliberate patience of the punch card investor. It is the path of the action bias. The action bias is our innate psychological tendency to favor action over inaction, even when inaction is the more rational course. In investing, this manifests as a constant need to be doing something. Many investors feel that if they aren't actively buying or selling, they aren't being productive. They check their portfolios multiple times a day, scour financial news for the latest hot tip, and treat the stock market like a casino. This high-frequency activity is the mortal enemy of long-term wealth creation. A perfect modern example of this was the meme stock craze. Hordes of retail investors, organized on social media, engaged in a frenetic churn of buying and selling stocks like GameStop and AMC. They were driven by stories, by momentum, and by a gambler's adrenaline rush. They were not making 20 deliberate decisions for a lifetime. They were making 20 impulsive decisions before lunch. There was no deep business analysis, no consideration of intrinsic value, no long-term thesis. It was pure, unadulterated action bias. The results were predictable. While a few who got in and out early may have made money, the vast majority who were caught up in the trading frenzy were left holding the bag when the prices inevitably crashed back to earth. They were not investing, they were gambling. The punch card mentality is the ultimate defense against this destructive impulse. It teaches you that in investing, your holding period should be forever. It teaches you that your best move, on most days, is to do absolutely nothing. It reframes activity not as a sign of engagement, but as a potential source of error. The goal is not to trade frequently, but to be right. This shift in perspective is what separates the amateur speculator from the professional capital allocator. The amateur is addicted to the thrill of the game. The professional is focused solely on the final score. The financial connection between the punch card mentality and long-term wealth is direct, tangible, and enormous. It comes down to two of the most powerful and often overlooked forces in finance: transaction costs and taxes. Every time an investor succumbs to the action bias and makes a trade, they incur costs. There might be a direct commission fee, but more insidiously, there is the bid-ask spread, a hidden cost that slowly bleeds a portfolio dry. For the hyperactive trader, these small cuts add up to a death by 1,000 paper cuts, a significant and guaranteed drag on performance year after year. The punch card investor, who may only make 1 or 2 trades in a year or even a decade, almost entirely sidesteps this wealth-destroying friction. But the far greater advantage lies in tax efficiency. This is a concept critical to any serious discussion of wealth management. When you sell a stock that you've held for less than a year, any profit is considered a short-term capital gain and is taxed at your ordinary income tax rate, which can be as high as 37% or more. When you sell a stock you've held for more than a year, the profit is a long-term capital gain, taxed at a much more favorable rate, typically 15 or 20%. The hyperactive trader is constantly generating short-term gains, handing over a huge chunk of their profits to the government each year. This is a massive, self-inflicted wound to their compounding process. The punch card investor, by contrast, rarely sells. Their strategy is to buy a wonderful business and hold it for decades. This means their enormous capital gains are allowed to compound year after year, tax-deferred. The money that would have been paid in taxes remains invested, working for them. Let's consider a simple example. An investor who makes a 15% return and sells every year, paying a 37% short-term capital gains tax, is only left with a 9.45% net return to compound. An investor who makes the same 15% return but doesn't sell allows the full 15% to compound for decades. Over a 30-year period, this difference is staggering. The punch card investor's portfolio will be more than double the size of the active trader's, for no other reason than the brutal mathematics of tax efficiency. This is how focus investing, with its inherent low turnover, becomes one of the most powerful strategies for beating the market and achieving genuine financial freedom. It aligns your behavior with the powerful forces of compounding and tax deferral, creating a tailwind that pushes you toward your goals, while the active trader is constantly fighting against a self-imposed headwind. The first two pillars have established a new philosophy of risk and a new discipline for decision-making. The third pillar provides the essential foundation upon which both of those can be safely built: the circle of competence. This is perhaps the most famous of Buffett's mental models. The concept is disarmingly simple. Each of us, through our experiences, careers, and studies, has built up a deep well of knowledge in a few specific areas. Inside this circle, we have a genuine advantage. We understand the nuances, the competitive dynamics, and the key variables for success. Outside of this circle, we are amateurs, operating with a significant disadvantage. Buffett's rule is to draw a line around this circle and never, ever step outside of it when making an investment. It doesn't matter how big your circle is. What matters is that you know precisely where the perimeter lies and that you have the discipline to stay within it. True investment safety, therefore, does not come from owning 100 different stocks. It comes from the deep, almost obsessive knowledge you possess about the 2 or 3 stocks you do own. This is why portfolio concentration is only a viable strategy when practiced in conjunction with the circle of competence. Betting big on something you understand intimately is the definition of rational investing. Betting big on something you don't understand is the definition of reckless gambling. The circle of competence is the intellectual firewall that separates the two. It's an act of profound intellectual humility. It's the admission that you cannot be an expert in everything, and that your time and energy are best spent deepening your knowledge within your existing circle rather than superficially expanding its circumference. The most dramatic and instructive example of Buffett's unwavering commitment to this principle occurred during the late 1990s, at the peak of the dot-com bubble. Technology stocks were soaring to unimaginable heights. Any company with .com in its name was doubling, tripling, or quadrupling in value overnight. The world was convinced that a new economy had been born, one that rendered old metrics like profits and cash flow obsolete. And Warren Buffett, the Oracle of Omaha, was completely on the sidelines. He wasn't buying technology stocks, he wasn't buying internet stocks. Berkshire Hathaway's performance was lagging the S&P 500, and the financial press was merciless. He was openly mocked. He was called a dinosaur, a relic from a bygone era who just didn't get it. Barron's, a prominent financial magazine, ran a cover story titled, "What's Wrong, Warren?" The pressure to abandon his principles and join the party must have been immense. His investors were questioning him. His reputation was on the line. But Buffett's response was simple and unwavering. He explained that these technology companies were outside of his circle of competence. He said he had no special insight into which of the hundreds of competing tech companies would be the long-term winners. He couldn't confidently project their cash flows 10 or 20 years into the future. He didn't understand their competitive advantages or how durable they would be. And because he didn't understand them, he would not invest. It wasn't that he thought they were all bad businesses. It was that he couldn't tell the good from the bad. He knew where the edge of his circle was, and he refused to be tempted or shamed into crossing it. Then, in the spring of 2000, the bubble burst. The Nasdaq index, filled with the tech darlings of the day, collapsed by over 75%. Fortunes were vaporized. The new economy was exposed as a delusion. And Warren Buffett, the dinosaur, was vindicated in the most spectacular fashion. His discipline had not cost him money. It had saved him and his shareholders from a historic financial calamity. This story is the ultimate testament to the power of the circle of competence. It demonstrates that the most important word in investing is often no. The ability to say no to tempting, popular, and exciting opportunities that lie outside your area of expertise is the single greatest defense against permanent capital loss. Your knowledge is your moat, and venturing beyond it leaves you defenseless. The psychological demon that the circle of competence is designed to slay is the overconfidence bias. This is our pervasive tendency to have excessive confidence in our own answers to questions. We systematically overestimate our knowledge and our ability to predict outcomes. An investor reads a few articles about a revolutionary new gene editing technology and suddenly believes they are qualified to pick the winning biotech stock in a field crowded with PhD scientists. An amateur investor watches a documentary about electric vehicles and feels confident they can predict which of the 50 EV startups will become the next Tesla. This is overconfidence in action, and it is a portfolio killer. The circle of competence is a deliberate, systematic tool to counteract this bias. It forces you to replace subjective feelings of confidence with an objective assessment of your actual knowledge base. It demands that you ask not, "Am I excited about this story?" but rather, "Do I have a demonstrable, provable edge in understanding this specific business and industry?" This is an uncomfortable process because it often forces us to admit how little we truly know. But this admission is the beginning of wisdom. It shifts the goal from trying to be a jack of all trades to becoming a true master of one. Buffett himself is a perfect example. His circle includes insurance, banking, consumer staples, and railroads, businesses with relatively stable economics that he has studied for over half a century. His deep knowledge in these areas gives him the confidence to make huge, concentrated bets when prices are attractive. But that same humility causes him to readily admit his ignorance in other areas, like pharmaceuticals or enterprise software. He is not trying to be the smartest person in every room, only in his own carefully selected room. By forcing this intellectual honesty, the circle of competence protects us from our own worst enemy, the dangerous illusion that we are smarter than we actually are. To make this concept a practical reality, you must undertake the exercise of mapping your circle. This is a tangible blueprint for defining your personal investment universe. Take a large blank sheet of paper and divide it into 3 columns. The first column is labeled expert, the second competent, the third ignorant. Now, begin to populate these columns with various industries and business models. The expert column is the most important and should be the most difficult to fill. Under this heading, you should only list industries or business types where you have a deep, almost professional level of understanding. This knowledge typically comes from one of 3 sources: your career, a lifelong passion or hobby, or years of intense, deliberate study. A software engineer might put software as a service, SaaS, businesses in this column. A doctor might list medical device companies. An avid lifelong gamer might list video game publishers. These are the areas where you have an unfair advantage. You understand the jargon, you know the key players, and you can see trends developing before they hit the front page of the financial news. The competent column is for areas where you have some knowledge, but not true expertise. Maybe you've read a few books on the industry or followed it casually. You understand the basics, but not the deep nuances. This column serves as a watch list, areas where you might, with significant effort, be able to upgrade your knowledge to expert level over time. The ignorant column should be the largest. This is for everything else. For most people, this will include things like biotechnology, complex financial derivatives, mining exploration, and so on. Be brutally honest. There is no shame in admitting ignorance. The only shame is in acting on it. Once your map is complete, the rule is simple and absolute. Your punches from the punch card can only come from the expert, a column. Your entire focus for high-conviction, concentrated investing is now limited to this small, well-defined universe. This exercise transforms the abstract idea of a circle of competence into a concrete, personalized investment strategy. It ensures that when you do make a concentrated bet, you are swinging in your own wheelhouse, dramatically increasing your odds of success. The antithesis of this disciplined approach, the path followed by the 99%, is known as style drift. This is the tendency for investors to abandon their core competencies and chase whatever is hot. They wander outside their circle of competence, lured by the siren song of quick and easy profits. An investor who made their money successfully investing in dividend-paying utility stocks for 20 years suddenly sees their neighbor getting rich on cryptocurrency and decides they need to get in on the action. They have no deep understanding of blockchain technology, monetary theory, or cryptographic security, but they buy anyway. They have drifted from their circle. An investor with a background in manufacturing who understands supply chains and industrial processes gets caught up in the hype around cannabis legalization and starts buying shares in Canadian pot stocks. They know nothing about agricultural yields, regulatory hurdles in different jurisdictions, or the branding of consumer packaged goods. They have drifted. A classic example of the devastating effects of style drift was the alternative energy bubble in the mid-2000s. Spurred by rising oil prices and political narratives, investors poured billions of dollars into solar, wind, and ethanol companies. Many of these were value investors, traditionally focused on stable, profitable businesses, who drifted into a highly speculative, capital-intensive, and technology-dependent sector they did not understand. They were investing in a story, not a business. When the financial crisis hit and government subsidies dried up, many of these companies went bankrupt, wiping out shareholders completely. These investors were not stupid. They were simply operating outside their circle of competence. They were the sucker at the poker table, playing a game where other players had a massive information advantage. Sticking to your circle doesn't guarantee you'll win, but it ensures you're playing a game you actually understand, which is the first and most critical step towards long-term investment success. The direct financial connection between staying within your circle and achieving superior returns lies in the concept of information asymmetry. The stock market is not a level playing field. It is a fiercely competitive arena where you are pitted against some of the smartest, most well-informed, and best-resourced people in the world: hedge fund analysts, private equity titans, and industry insiders. When you invest in a company outside your circle of competence, you are operating with a severe information-type disadvantage. The person on the other side of your trade likely knows more about that company than you do. You are, by definition, the less informed party. This is a losing proposition. However, when you invest exclusively within your circle of competence, the dynamic can flip. You may actually possess an information-time advantage, NIBS. That software engineer who invests in a SaaS company from their expert column understands the product, the customer pain points, and the competitive landscape better than a generalist Wall Street analyst covering 50 different tech stocks from a spreadsheet in a Manhattan skyscraper. The doctor analyzing a medical device company can assess its clinical utility and potential adoption by fellow physicians in a way that a finance MBA cannot. This ground-level, specialized knowledge is where true alpha, or market-beating returns, is generated. It's your edge. Portfolio concentration magnifies this effect. By placing a large bet on a company where you have a genuine information advantage, you are maximizing the financial impact of your unique expertise. Diversifying into areas where you are ignorant means spreading your capital across a series of bets where you are at a distinct disadvantage. The choice is clear. You can either make a few large bets on games you are favored to win, or you can make many small bets on games you are almost certain to lose. The entire premise of beating the market is built on exploiting these pockets of informational advantage, and those pockets can only be found inside your own, well-defined circle of competence. We have now established a framework for thinking about risk, a discipline for making decisions, and a boundary for where to operate. The fourth pillar addresses the economic engine that powers this entire strategy. The fundamental difference between a great business and a merely good one, and why your portfolio should be dominated by the former. Early in his career, Buffett followed the teachings of his mentor, Benjamin Graham, and practiced what he called cigar butt investing. He looked for businesses that were statistically cheap, companies that were so beaten down and unloved that they could be bought for less than their liquidation value. They were like a discarded cigar butt found on the street. There was one free puff left in it. You could buy it, take that one puff, and throw it away for a small, quick profit. This strategy worked, but it was not scalable, and it lacked long-term compounding power. It was Charlie Munger who pushed Buffett to evolve his thinking, to shift from buying, quote, fair companies at wonderful prices to buying wonderful companies at fair prices. A great business, one with a durable competitive advantage or moat, has the ability to reinvest its earnings at a very high rate of return over a long period of time. This internal compounding is a far more powerful force for wealth creation than the one-time gain from buying a cheap, mediocre business. This realization is the economic justification for portfolio concentration. The financial performance of a truly wonderful business will be so vastly superior to that of a good or average business that it is a grave error to give them similar weightings in a portfolio. Your goal as a focus investor is not just to find undervalued assets. It is to identify these extraordinary compounding machines and then invest as much as prudence allows, letting the economics of the great business do the heavy lifting for you over decades. The pivotal moment in this philosophical shift for Buffett was his acquisition of See's Candies in 1972. On the surface, it seemed like a departure from his usual strategy. See's was not a statistically cheap cigar butt. Buffett and Munger paid $25 million for a company that had only $8 million in tangible assets. They were paying a significant premium over its book value. A strict Graham-style value investor would have walked away immediately. But Buffett and Munger saw something that wasn't fully captured on the balance sheet. An incredible, intangible asset in the form of a powerful brand and immense customer loyalty. See's Candies held a special place in the hearts and minds of its customers, particularly in California. It was the default gift for birthdays, holidays, and special occasions. The brand was synonymous with quality and nostalgia. This deep customer loyalty gave See's something truly magical: pricing power. Every year, the company could raise its prices slightly to cover inflation and then some, and the customers would happily pay. They weren't just buying chocolate. They were buying a feeling, a tradition. This pricing power, combined with a business model that required very little capital to grow, meant that See's Candies was a cash-generating machine. It produced high returns on its minimal invested capital and threw off more and more cash year after year, cash that Buffett could then use to invest in other wonderful businesses. The See's investment was a revelation. It taught Buffett that it was far better to pay a fair price for a business with a durable moat and high returns on capital than to get a bargain price on a struggling, capital-intensive business with no competitive advantage. See's demonstrated the power of long-term compounding driven by business quality. This experience solidified the logic of focus investing. If you are lucky enough to find a business like See's Candies, you don't just take a small position, you buy as much as you can. You concentrate your capital because you recognize that such opportunities are exceedingly rare, and their long-term economic performance will be so superior that they will dwarf the returns from a diversified portfolio of mediocre cigar butts. The underlying principle that explains why great businesses have such an outsized impact on portfolio returns is the power law distribution, also known as the Pareto principle or the 80-20th rule. In many domains, a small number of inputs are responsible for a large percentage of the outputs. In venture capital, a handful of investments in companies like Google or Facebook will generate nearly all of the fund's returns, while the rest will be failures or modest successes. The same is true in a stock portfolio. Over a long period, a small number of your holdings will be responsible for the vast majority of your gains. Buffett's strategy of portfolio concentration is a conscious and deliberate decision to lean into this reality. Instead of trying to own a little bit of everything, he tries to identify those potential big winners in advance and invest heavily in them. He understands that finding one business that can compound at 20% per year is infinitely more valuable than finding 10 businesses that will compound at 8%. The mathematical difference over time is not linear, it's exponential. The focus investor is essentially making a bet that they are good enough at business analysis to identify these outliers. This approach is also a powerful antidote to a destructive psychological bias known as loss aversion. Research has shown that humans feel the pain of a loss about twice as strongly as the pleasure of an equivalent gain. This leads to irrational investment behavior. Investors tend to sell their winners too early to lock in a gain, because the pleasure of that small, certain profit outweighs the potential for a much larger, uncertain future gain. Conversely, they hold on to their losers for far too long, hoping they will get back to even, because selling would mean realizing the painful loss. This behavior results in a portfolio where the weeds are watered and the flowers are cut. A concentrated portfolio forces the opposite behavior. When a single stock makes up 25% of your portfolio, you are forced to be far more rational. You must let your winners run, because their outperformance is the entire justification for your strategy. And if a thesis for one of your big bets proves to be wrong, you must be ruthless in cutting the position, because holding a large, losing position in a deteriorating business is a recipe for disaster. Concentration forces a professional discipline that counteracts the amateurish, emotion-driven impulses of loss aversion. To apply this principle, you need a systematic way to differentiate a truly great business from a merely good one. This blueprint is the moat identification checklist. Before any business can be considered for a concentrated position, it must have a clear and durable competitive advantage. This checklist helps you identify the source and strength of that moat. There are 5 primary types of moats. First, brand power, an intangible asset. Think of companies like Apple or Coca-Cola. Their brands allow them to charge a premium price for products that are not fundamentally different from their competitors. The brand creates an emotional connection and a shortcut for trust in the consumer's mind. Second, switching costs. This is when it is expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Think of the operating system on your computer or the banking relationship you've had for 20 years. High switching costs create a captive customer base and predictable revenue streams. Third, network effects. This occurs when a product or service becomes more valuable as more people use it. Social media platforms like Facebook or credit card networks like Visa are classic examples. A new competitor has an almost impossible task because they cannot offer the same value until they reach a similar scale. Fourth, cost advantages. This can come from scale, like Walmart, which can negotiate better prices from suppliers than its smaller rivals, or from a unique process, like Geico's direct-to-consumer insurance model, which bypasses costly agents. These companies can either undercut competitors on price or enjoy higher profit margins. Fifth and finally, intangible assets that are not brands. This includes patents that protect a pharmaceutical drug, or government licenses and approvals that are required to operate in a certain industry, like a railroad or a utility. Your task as an analyst is to run a potential investment through this checklist. Does it have a moat? Which category does it fall into? How strong and how durable is it? A truly great business will score very highly on at least one of these dimensions. A business that doesn't have a clear answer on this checklist is likely a commodity-type business, destined for mediocre returns, and is not a candidate for a concentrated, long-term investment. The antithesis to buying wonderful companies is the path of chasing yield and falling into value traps. This is a common mistake made by the 99% who are looking for what appears to be a bargain. They scan the market for stocks with very low price-to-earnings ratios or exceptionally high dividend yields. They believe that cheapness is a sign of a good investment. More often than not, they are stepping into a value trap. A value trap is a stock that appears cheap for a very good reason. Its underlying business is in a state of terminal decline. Think of a newspaper chain in the age of the internet, a department store chain competing against e-commerce, or a landline telephone company in the age of the smartphone. These businesses might look cheap based on their past earnings, but their future earnings are heading towards zero. The investor who buys a diversified portfolio of these high-yield, low-PE stocks is not a savvy value investor. They are a collector of melting ice cubes. They are lured in by the siren song of a high dividend yield, not realizing that the dividend is unsustainable and likely to be cut as the business deteriorates. They are focused on the rearview mirror of past performance, not the open road of future prospects. This approach is the polar opposite of Buffett's focus on quality. A great business like See's Candies may look more expensive on a simple PE basis than a struggling department store, but the great business will be growing its intrinsic value year after year, while the value trap is systematically destroying it. The investor chasing yield is concentrating on the return of their capital, in the form of dividends, while the investor focused on quality is concentrating on the long-term return of their capital, which is a far more powerful engine for wealth creation. The direct financial connection between concentrating in great businesses and building wealth is best explained by the concept of return on invested capital, or ROIC. ROIC is a measure of how good a company is at turning its capital into profits. A company with a high ROIC is a highly efficient wealth creation machine. Imagine two businesses, Company A and Company B. Company A is a wonderful business with a strong moat that consistently generates a 20% return on invested capital. For every dollar it reinvests back into its operations, it generates 20 cents of profit each year. Company B is a mediocre, capital-intensive business that only generates a 5% return on invested capital. Now let's assume both companies earn $1 million in profit this year and reinvest all of it back into the business. Company A, the great business, will increase its future annual earnings power by $200,000. Company B, the mediocre business, will only increase its future earnings power by $50,000. The great business is compounding its intrinsic value at 4 times the rate of the mediocre business. Over 10 or 20 years, this difference becomes a chasm. The stock price will eventually follow this underlying growth in intrinsic value. A portfolio that is concentrated in a handful of high ROIC businesses has a powerful, built-in economic tailwind. The managers of those businesses are effectively working for you, reinvesting your capital at very high rates. A diversified portfolio of average ROIC businesses has no such tailwind. It is destined to plod along, generating returns that are, at best, average. This is the core mathematical engine of long-term value investing and the ultimate financial justification for focus investing. You are not just buying a stock. You are buying a share of a compounding machine. Your goal is to find the most powerful machines and invest in them with conviction. This brings us to our fifth and final pillar, which addresses the practical and psychological challenges of implementing this strategy. It is the battle against di-worsification. This is the term Buffett and Munger use to describe the process by which investors, even smart ones, start with a few great ideas and then gradually add more and more mediocre ideas to their portfolio until the brilliance of their original insights is completely diluted. It's the tendency to over-diversify out of a misguided sense of safety or a fear of being wrong, ultimately leading to a portfolio that is guaranteed to underperform its own best ideas. Overcoming diversification is about having the courage of your convictions. It's about understanding that once you have identified a truly wonderful business at a fair price, the biggest risk is not owning too much of it, but owning too little. It requires a mindset shift from "how can I avoid being wrong?" to "how can I maximize the returns from being right?" This final pillar is about the discipline required to maintain a concentrated portfolio, to prune the weeds, and to continually reallocate capital to your highest and best ideas, even when it feels psychologically uncomfortable to do so. Perhaps the most potent modern example of Buffett's commitment to avoiding diversification is Berkshire Hathaway's colossal investment in Apple. By the late 2010s, after years of avoiding technology stocks, Buffett, working with his investment lieutenants, began to build a massive position in the iPhone maker. He came to see Apple not as a technology company, a sector outside his circle of competence, but as a consumer products company with one of the most powerful brands and ecosystems in the world, a moat he could understand. The loyalty of Apple's customers, their willingness to pay a premium price, and the high-margin, recurring revenue from the App Store all looked very similar to the economics of a business like See's Candies or American Express, just on a much grander scale. What is truly remarkable is the sheer conviction he displayed. He didn't just dip a toe in the water. By 2020, Berkshire Hathaway's investment in Apple had grown to be worth over $100 billion, and it constituted more than 40% of Berkshire's entire publicly traded stock portfolio. This is the antithesis of diversification. At the scale of one of the largest corporations in the world, Buffett was still practicing the principles of extreme portfolio concentration. He had found a truly wonderful business, run by excellent management, at a price he found reasonable, and so he bet big. He could have easily diversified that $100 billion across 50 other good tech companies. But he knew that would have been a mistake. It would have diluted the impact of his single best idea. The Apple investment is a powerful, real-world lesson that the principles of focus investing are not just for small, nimble investors. They are scalable, timeless principles of rational capital allocation. It demonstrates a profound confidence that comes only from deep research and a commitment to let your best ideas have a meaningful impact on your financial results. The psychological force that pushes most people towards diversification is one of the most powerful biases in human nature, the herd mentality and our reliance on social proof. We are social creatures, and for millennia, our survival depended on staying with the tribe. Going against the group was dangerous. This instinct is still deeply wired into our brains. In finance, diversification is the ultimate form of social proof. Everyone says you should do it. Every financial advisor recommends it. It is the accepted, conventional wisdom. To choose to concentrate your portfolio in just a few stocks is to choose to stand apart from the herd. This is psychologically difficult. When your concentrated portfolio is underperforming the market, as it inevitably will from time to time, you will feel the intense pressure of social proof. You will see your friends with their diversified index funds getting better returns, and you will question your own judgment. You will feel foolish. It is this fear of being wrong and alone that drives many investors to diversify. They add more and more stocks to their portfolio not because of deep conviction, but to feel safer, to look more like everyone else, to blend back into the comfort of the herd. They are trading the potential for extraordinary returns for the psychological comfort of being average. Buying a broad market index fund is the ultimate act of herding. It is an explicit decision to accept the average return, no better and no worse. While this may be a perfectly reasonable strategy for someone who is unwilling or unable to do the work of business analysis, it is a trap for the serious investor. Diversification, driven by herd mentality, is a silent killer of alpha. It provides the illusion of safety while guaranteeing the reality of mediocrity. To actively combat this tendency and maintain a focused portfolio, you need a systematic process for quality control. This blueprint is the portfolio pruning process. It is a scheduled, unemotional ritual conducted once or twice a year designed to fight against the natural creep of diversification. The process has 4 steps. Step 1. Rank your holdings. List every single investment in your portfolio, from the one you have the absolute highest conviction in at the top to the one you have the least conviction in at the bottom. This simple act of forced ranking often reveals which positions have no business being in your portfolio. Step 2. Interrogate the bottom. Take the bottom 10 to 20% of your holdings, your weakest ideas, and put them on trial. For each one, you must ask the killer question: if I were starting today with 100% cash, would I buy this stock at its current price? Be brutally honest. Do not let the fact that you already own it influence your decision. Step 3. The mandate to sell. If the answer to that question is no, then you have a clear mandate to sell the position. It doesn't matter if you have a small loss or a small gain. Its continued presence in your portfolio is a drag on your performance and a distraction of your mental energy. It is a weed that must be pulled. Step 4. Reallocate to strength. The capital raised from selling your weakest ideas should not be left in cash. It should be immediately reallocated to your strongest convictions, the top 1 or 2 holdings on your list. This process systematically and deliberately concentrates your capital over time into your very best ideas. It is an active, ongoing fight against mediocrity. The portfolio pruning process transforms you from a passive collector of stocks into an active manager of a focused, high-performance portfolio, ensuring that your capital is always working for you in the most intelligent way possible. The ultimate financial distinction between a concentrated, high-conviction approach and a diversified one comes down to the concepts of alpha and beta. In investment terminology, beta represents the return of the overall market. You can capture beta simply by buying a low-cost S&P 500 index fund. If the market goes up 10%, you go up 10%. It requires no skill. Alpha, on the other hand, is the excess return you generate above and beyond the market's return. It is the measure of your skill as an investor. If the market goes up 10% and your portfolio goes up 15%, you have generated 5% of alpha. The entire business of active wealth management is, in theory, the pursuit of alpha. The problem is that broad diversification is the mathematical enemy of alpha. As you add more and more stocks to your portfolio, its performance will inevitably begin to look more and more like the overall market. A portfolio of 100 stocks is, for all practical purposes, a closet index fund. By diversifying so broadly, you have mathematically guaranteed that your beta will be 1 and your alpha will be 0. You have diversified away any chance of outperformance. Portfolio concentration, on the other hand, is a deliberate strategy to maximize alpha. You are explicitly stating that you are not content with market returns. You are making a handful of large, non-consensus bets in companies you understand deeply, with the express goal of generating returns that are significantly different from and superior to the market average. Looking at the long-term track records of legendary focus investors like Warren Buffett, Charlie Munger, or Lou Simpson, you see this in action. Their returns are not just slightly better than the market, they are in a different universe. This massive outperformance is the direct result of their willingness to stand apart from the crowd, to shun diversification, and to concentrate their capital in their very best, high-conviction ideas. This is the final and most powerful connection. The choice to concentrate is the choice to pursue excellence, to back your own judgment, and to unshackle yourself from the gravitational pull of market mediocrity in the quest for true, life-changing financial success. You have just been given the master key to a different way of thinking about wealth. You have journeyed through the 5 fundamental pillars of Warren Buffett's controversial and powerful philosophy on portfolio concentration. You now understand that true risk is not volatility on a screen. It is the permanent loss of capital that comes from ignorance. You possess the punch card mentality, a powerful discipline to make fewer, better decisions, transforming you from a frantic speculator into a patient capital allocator. You have a practical blueprint to map your circle of competence, ensuring you only play the games where you have a genuine advantage. You can now distinguish the powerful economics of a great business from a good one, and you understand why your best ideas deserve to dominate your results. And finally, you have a system to fight back against the silent killer of returns, diversification. You have acquired a complete mental toolkit designed not for average returns, but for the pursuit of extraordinary results. But a single toolkit, no matter how powerful, is not the entire structure. Buffett's system for wealth creation is not just one idea in isolation. It is an interconnected latticework of mental models, each supporting and reinforcing the others. You have just mastered the crucial half of the equation that answers the question what to buy and how much to buy. But there is another, equally critical half of the equation that the world's greatest investors live by. It answers the question, at what price should I buy it? The most wonderful business in the world, bought at a foolishly high price, can be a terrible investment. The principle that governs this second half of the equation, the bridge that connects brilliant business analysis to profitable investment action, is known as the margin of safety. It is the single most important concept for protecting yourself from the inescapable reality that the future is uncertain and that you will, at times, be wrong. The video that YouTube has selected for you, the one that is now on your screen, is the next part of that map. It is the missing link. It is the piece that connects the intellectual exercise of identifying a great company with the practical, wealth-building act of buying it at a price that offers both immense upside and powerful downside protection. You have already proven, by watching this far, that you are not a passive observer content with financial mediocrity. You are an architect, someone actively seeking the blueprints to construct your own financial future. The choice to click is therefore not about simply watching another video. It is a conscious decision to lay the second foundational pillar of your fortress of financial freedom. You have built the wall of concentration. Now you must dig the moat of safety. Do not break the momentum of your own intellectual ascent. Complete your mental arsenal. Continue the journey.